If interest rates are tied to the choices made by the Fed, why the heck are all these mortgage companies offering different rates? It may seem arbitrary, but each company is making their decision based on how they function as a lender and the circumstances of the market. Don't take out a mortgage without understanding how the market works. To understand how mortgage lenders set their rates, first we need to understand the process or the mortgage cycle. While you might feel like you make a deal with one entity and then pay that entity money for 30 years, what's going on behind the scenes with your mortgage has many more steps. This is because in order for your lender to make money off your loan, they usually have to sell your mortgage. That sounds weird at first, but let's consider how interest works over time. Let's say Anne lends Emily $100,000 at 3% interest. That means the interest is worth $3,000 right now. But what if interest rates go up in the market? If rates go up to 6%, now a $50,000 loan is worth $3,000 in interest. Anne is still stuck with Emily's 3% loan worth $3,000 in interest, even though a loan of the same size at 6% is worth double the interest. Lenders would consider this loan to have lost value compared to other loans on the market. This is an oversimplification of loan values over time. But as you can see, mortgage companies don't want to run the risk every year of interest rates going up and the value of their current loans dropping enough to cut their company's worth in half. To protect themselves from this risk, mortgage companies will usually sell your mortgage to pass on the risk through the mortgage cycle. Let's take a closer look at the steps of a mortgage cycle so you can understand what's going on from your lender's point of view. A borrower goes to a mortgage originator to obtain the loan. The originator will submit that loan to a mortgage company or banker to fund the loan. Sometimes, the loan can be originated and funded by the same company, but not always. Once closed, the loan is then handled by a servicer. The servicer is the company that actually accepts your monthly payments and sends the money on to the proper groups, including the investor who owns the mortgage, taxes, insurance, and other included fees. They're also the company that will answer your questions. For the life of the loan, you are interacting with the servicer. However, they do not own the loan. It's like a bus driver on a bus. You give them money, but they don't own the bus. They just drive it while the city technically owns the bus. So what's in it for the servicer? They actually pay for the right to service your loan, about 1% of the loan amount up front. Why do they do this? Because they will receive a monthly payment called a strip out of the payments you make on the loan. The servicer essentially pays 1% for the right to drive the bus and keep some of your fare. As borrowers, we should appreciate the role the servicers play, because it means we only have to interact with one company, even though our loan will likely be passed through at least 4, possibly more owners. Imagine if every time someone sold your loan, you had to be sent new information on where to send your payments and how to send them. What a mess. And your loan will be sold many times before you pay it off. The mortgage company who originally funded your loan is not going to keep it, as we noted before, because interest rates will probably go up, so the value of the loan will decrease. So they sell your loan and use that money to fund others' loans. They will sell your loan to an investor, or sometimes to the servicer company. The investor then sells it on to an aggregator, usually a government agency like Fannie Mae or Freddie Mac. They put your one loan into a bundle, making a larger asset that is then passed on to an investment banker. The investment banker takes the bundle of loans and converts them into a mortgage-backed security, MBS, which is sold to the public, usually in investment accounts like mutual funds, insurance plans, and retirement accounts. Keep in mind that every step of the mortgage cycle comes with fees, taking value off the mortgage itself and leaving a smaller return for the end investor. It's usually assumed the final investor will receive an asset worth 1% less in interest than the borrower is actually paying. So the mortgage you get at a 4% interest rate will probably earn the end investor about 3%. The MBS market price is the biggest factor going into a lender's calculation because they want the asset to be attractive to end investors. However, they have to include a buffer of risk in case the MBS price changes between the time the interest rate is agreed and the time the loan closes. Think about our previous example. You, the borrower, agree to a 3% loan, but before the lender can sell it, MBS rates jump up and loans are now going at 6%. Before the loan closes, the lender has already lost money because now they have to cover the difference and buy down the borrower's mortgage rate to the level they were promised. This is because the lender has to pass on the mortgage at the going rate, but because they already agreed to a much lower interest rate to the borrower, they have to make up the difference. When your lender is deciding on your rate, they are thinking about the entire mortgage cycle and their place in it. But wait, if all mortgage lenders sit in the same place in the cycle and the cycle works the same for all loans, why don't they offer the same rate? That's because not all lenders are the same. Some lenders work as the originator, funder, and servicer, some only one or two of the three. Other lenders have a very different structure that changes who gets paid and where your loan will go. Now that we have a better idea of how the mortgage market works in general, let's inspect the different kinds of lenders and what makes them provide different rates. Lender type number 1, direct lenders. Direct lenders originate their loans, meaning that they put up the money for the loans themselves. They do this either with their own funds or by taking out loans themselves. They can also raise capital from investors to offer loans directly to borrowers. Direct lenders can conduct the entire mortgage process without needing intermediaries. They can process, underwrite, and close your loan themselves. Direct lenders are great if you're looking for a speedier loan process, since there is no middleman and the process will feel much the same to the borrower as working with a mortgage loan originator. Examples include mortgage banks and portfolio lenders. Lender type number 2, wholesale lenders. You, as an individual consumer, are not likely to come into contact with wholesale lenders. This type of lender funds mortgages for third parties, not the mortgagee. For example, a wholesale lender will fund mortgages for banks, credit unions, and mortgage brokers. The banks, credit unions, and mortgage brokers working with the borrower will assess their creditworthiness. Wholesale lenders sell directly to aggregators shortly after closing. Lender type number 3, retail lenders. Different from wholesale lenders, retail lenders offer mortgages to individuals, not institutions. They work with prospective home buyers directly. Examples include some credit unions, banks, and mortgage banks. One benefit of working with a retail lender is they sell multiple loan products, so you can consider the options and pick the best one for you. A retail lender is a type of direct lender, as they fund it and provide it directly to the consumer. Lender type number 4, portfolio lender. A portfolio lender uses money generated from its investments to originate mortgages. One example is a community bank. Portfolio loans are considered non-conforming loans and can't be sold on the secondary market. Portfolio lenders instead keep their loans in their portfolio instead of selling to aggregators. Because portfolio lenders hang on to their loans instead of selling them on the secondary market, they can set their own standards and offer less strict criteria than conventional banks. If you don't meet Fannie Mae and Freddie Mac's guidelines, a portfolio lender may be your best option. They're also a good option for larger than average or jumbo loans. A portfolio lender can even make the decision to offer loans to those with poor credit scores based on another metric, like a personal relationship or connection with the community. These are high-risk loans, so the lender will usually charge high interest rates, closing costs, and other fees. Lender type number 5, online lenders. Online lenders offer an alternative to traditional banks. They can originate your loan entirely online without you ever having to go to a physical location or even hop on the phone. They're not much different from other retail lenders in practice, but because they have fewer overhead costs, they can pass the savings on to their customers. These lenders will offer lower interest rates and fees, so you can save thousands of dollars over the life of your loan. These lenders are beholden to the mortgage cycle like everybody else, though, so you will still need to meet standard requirements to get a loan. Lender type number 6, correspondent lenders. These lenders take on the first part of the mortgage process before selling the loan to a larger lender who services the loan and may choose to sell the loan again on the secondary market. Your correspondent lender will originate, underwrite, and fund the mortgage under their own name using their own line of credit. As soon as the loan closes, they sell it to the larger lender and use the proceeds to pay off their line of credit. Correspondent lenders are often very quick options for lenders because underwriting and approval are handled in-house, as opposed to working with an originator who has to communicate with a lender. They may also offer more mortgage options because they work with a wide variety of investors to get their credit line. However, there are specific policies for who can qualify for a correspondent loan, and this lender may charge extra fees up front. Lender type number 7, warehouse lenders. These are financial institutions who offer short-term financing to a bank or other institution who offer loans without using their own capital. The warehouse lender is not interacting with a borrower or even technically funding their loan. They are instead offering a line of credit to the mortgage lender so they can lend out the money. The mortgage lender must then repay the warehouse lender with the money they get when they sell the loan. The mortgage itself is used as collateral until the mortgage lender repays the warehouse lender. Lender type number 8, hard money lenders. This type of loan uses the property itself as collateral and must be repaid within a few years. If the borrower defaults on the loan, the lender will take possession of the property. Because of this, it's not the usual option for residential homeowners. Instead, this is used by house flippers or other real estate investors who are trying to resell quickly, often after some renovations that will improve the house's sale price. They will take out a hard money loan, revamp the house, sell it at a profit, and pay back the loan, if all goes according to a plan. If it doesn't, their lender will take the property. This type of lender is usually a privately funded company or even one wealthy individual. They typically charge a substantial loan origination fee and require larger down payments and higher interest rates. Another reason this is not often considered an option for buyers who intend to live in the home. How do all these different lenders decide on the rates? It depends on their margins or the percentage of profit they are likely to make on the loan. The lenders with large offices and staff, like traditional banks, will usually have higher rates because they need to cover their overhead. This is why we see lower interest rates and fees from online lenders, who don't have those expenses, so they don't need to pass that cost on to you. When lenders want to be competitive in the market, they will usually lower interest rates. However, as a consumer, we have to be careful because some lenders will appear to be offering lower rates than others, only to sneak those costs into fees later. These include admin, underwriting, or origination fees. These fees are not expected or unreasonable in themselves, but they do mean that you need to include them when comparing mortgage options. If you only consider the interest rate, you might end up paying more every month because of fees. Look at a loan estimate to compare fees, APR, and rates to make an informed decision. You have to compare the final numbers because a low interest rate doesn't necessarily mean something shady is going on behind the scenes. Institutions like large banks will often have lower rates for large loans, even to the point of taking a loss. Why would they do this? Because they want to keep you as a customer and make money off your checking and savings accounts. If they sell you a mortgage, they can probably also sell you other products like CDs and personal loans. That means a loss on long-term mortgage loan can turn into customer loyalty and more profits overall. Mortgage rates are a combination of a lender's particular risk, margins, and desire to be competitive. But it all comes down to one thing: they want to make money off your loan. So make sure you do your research and compare multiple lenders to find the best deal for the entire life of your mortgage. Buying the wrong mortgage could be the worst financial mistake of your life, but it's probably not the only financial mistake many people make. What are the worst things you can do to yourself money-wise in your 30s? Watch this video to find out, and find out how to avoid them.